Hello everyone and welcome to Lesson 14 Complete Guide to Moving Averages in Forex Trading. In this lesson we are going to teach you all about moving averages. This video will be a little different than our previous lessons as we will be showing moving averages on a live trading platform. You will see how to set up and customize moving averages on a real trading platform. Moving averages are the bedrock of technical analysis, and it is important you understand how to use moving averages in your trading. By the end of this video you will know everything you need to know about moving averages. As a bonus we will be sharing with you some important trading strategies, and we will also demonstrate to you Smart Cloud, which is a marvelous and highly profitable trading system from smartforextrading.com. Before we start, make sure you subscribe to the channel and hit the like button. We really appreciate your support. And if you have any questions, put them down in the comments below. We always read your comments. If you are looking for a highly profitable trading system, you should head over to our website, smartforextrading.com. Over 90,000 traders use the Smart Forex Trading system. If you are struggling in your trading, you should start using the Smart Forex Trading system. Remember, once you have a profitable system, trading becomes easy. Make sure you like, subscribe, and turn on bell notifications. It really helps the channel to grow. Welcome to our complete guide to moving averages. We will be talking all about moving averages in this lesson. The first thing you will need to know is that moving averages are the most commonly used technical indicators. A quick and short explanation: moving averages smooth out price action for any given time frame. When you open any chart you will see a random pattern of candlesticks or bars. It is not so easy to spot the market direction. Is the market in an uptrend, downtrend, or ranging? By using a moving average you can quickly see the market direction and present state of the market. Moving averages will also help you to enter and close trades. Popular moving averages are the 9-period, 21, 50, 100 and 200 moving average. Let me plot each one of those moving averages on the chart for you so you can see them on the chart. We are using the gold market. Let's us first plot the 9 moving average. We need to go to our indicators at the top. Select moving averages in the indicators box and start typing moving averages, and we can select the indicator. Now let's open the settings. Click the gear icon. We can set the moving average period and color style in the settings. We can also choose the open or close for the settings. The preferred setting is at the close of a candlestick. We will set our first moving average to a period of 9 and we will set the color to blue. Now let's repeat what we have just done and plot our second moving average. This time we will set the settings to 50 and color the moving average to yellow. Again we go to the top, click indicators. Type in moving averages. And let's adjust the settings. Click the gear icon. In this case we want a period of 50 and the color style yellow. Before we start comparing the moving averages we will add one more so you get a really good understanding of how to plot moving averages. By now you will know exactly how we set a moving average. We click on indicators at the top. Type in moving averages. Select the moving averages indicator. We click on the gear icon and adjust the settings. We will set this moving average to 200 and color it red. Now we have 3 moving averages on our chart. The 9-period, 50 and 200 moving averages. You will see the 9-period follows the market price closely and moves in almost the same direction as the price action. The 9-period gives you the short-term price action. The 50-period moving average is much smoother and gives us much clearer picture of price action. The 200-period moving average is almost flat and gives the long-term price action. We can use these moving averages in many ways to help us in our trading. A very quick plan which is widely used by many traders is the 200 moving average. Traders use the 200 moving average to form a trading decision. If price action is above the 200 moving average, they will only place a buy trade. Conversely, if price action is below the 200 moving average, traders will be looking at only sell trades. There are many ways to trade with moving averages. Stick around and we will show a few more trading ideas, and we will even share with you in the bonus section the Smart Cloud, which is the ultimate moving average indicator designed by smartforextrading.com. Let's now dig a little deeper into what exactly is a moving average. A moving average is simply a way to smooth out price fluctuations to help you distinguish between typical market noise and the actual trend direction. The exact definition of moving average is: You take the average closing price of the market price and divide it by the relevant number of periods. By looking at the slope of the moving average, you can determine the trend direction. There are different types of moving averages and each of them has its own level of smoothness. Generally, the larger the period of the moving average, the slower it is to react to the price movement. The smaller the moving average, the quicker it is to react to the price movement. To make a moving average smoother, you should set the average closing prices over a longer time period. How to choose a moving average? The number of reporting periods set in the calculation affects how the moving average is displayed on a price chart. The smaller period is, the fewer the data points that are included in the moving average calculation, which means the closer the moving average stays to the current price. As we demonstrated, the 9 moving average closely follows the price action. It is basically copying the price action, and this reduces its usefulness and may offer less insight into the overall trend than the price action. The longer its length, the more data points that are included in the moving average calculation, which means the less any single price action can affect the overall average. If there are too many data points, price fluctuations may become far too smooth that you won't be able to detect any kind of trend. Either situation can make it difficult to recognize if price direction may change in the near future. For this reason, it's important to select the best number of periods that provides the level of price detail appropriate for your trading timeframe and trading strategy. There is no perfect moving average number. Every trader has their own preferences. To help new traders, we can point you in the right direction by giving you the most popular moving averages. Most traders like to use the 9 period as a fast moving average. With this, they will usually pair it with the 21 period moving average. The 50 moving average is an excellent indicator of a trend direction reversal. The 200 period moving average is useful to see the long-term trend. There are 2 major types of moving averages. 1. Simple moving average. 2. Exponential moving average. Before we move on, just remember that moving averages smooth price data to form a trend-following technical indicator. They do not predict future price direction. Instead, they define the current direction with a lag. Let's now explain to you what is a simple moving average. Basically, a simple moving average is calculated by adding up the last number of periods closing prices and then dividing that number by the number of periods. It is a simple calculation and hence why it is called the simple moving average. In charts you will see the abbreviation, SMA. How to calculate a 20-period moving average on a 1-hour time frame. If you plotted a 20-period simple moving average on a 1-hour chart, you would add up the closing prices for the last 20 hours, and then divide that number by 20. Fortunately, your trading platform will do all the calculations for you and there is no need for you to use your high school maths. Open your trading chart. Make sure the time frame is set to 1 hour. Plot a new moving average. Click on Settings. Adjust the period to 20 and just like that you have a 20-period moving average. Understanding how an indicator works means you can adjust and create different strategies as the market environment changes. With the use of simple moving averages, we can tell whether a pair is trending up, trending down, or just ranging. There is one problem with the simple moving average: they are susceptible to spikes. If you suddenly have big price movement, when this happens, this can give us false signals. We might think that a new currency trend may be developing, but in reality, it was just a spike. Now you understand simple moving averages, we will explain exponential moving average. As we said a moment ago, simple moving averages can be distorted by spikes. We can use exponential moving averages to smooth out the spikes. Exponential moving averages give more weight to the most recent periods. Exponential moving averages would put more weight on the prices of the most recent candlesticks. If you think about it, this makes a lot of sense because what this does is it puts more emphasis on what the price action is doing most recently. When trading, it is far more important to see what traders are doing now rather than what they were doing a few hours ago. Exponential moving averages are often referred to as EMA on charts. You might be asking which is better, simple or exponential moving averages. When you want a moving average that will respond to the price action rather quickly, then a short period EMA is the best way to go. These can help you catch trends very early, which will result in higher profit. In fact, the earlier you catch a trend, the longer you can ride it and catch bigger profits. The downside to using the exponential moving average, because the moving average responds so quickly to the price, you might think a trend is forming when it could just be a price spike. This would be a case of a false signal. When you want a moving average that is smoother and slower to respond to price action, then a longer period simple moving average is the best. This would work well when looking at longer time frames, as it could give you an idea of the overall trend. Although it is slow to respond to the price action, it could possibly save you from many fake outs. The downside is that it might delay you too long, and you might miss out on a good entry price or the trade altogether. With moving averages in general, the longer the time period, the slower it is to react to price movement. But with all else being equal, an EMA will track price more closely than an SMA. Because of this, the exponential moving average is typically considered more appropriate for short-term trading. The same attributes that make the EMA more suited for short-term trading limit its effectiveness when it comes to longer-term trading. Since the EMA will move with price sooner than the SMA, it often gets whipsawed, making it less than ideal for triggering entries and exits on slower chart timeframes like 1 hour or 4 hours. The SMA, with its slower lag, tends to smooth price action over time, making it a good trend indicator, allowing it to remain long when the price is above the SMA and short when the price is below the SMA. How to use moving averages to find the trend. One way to use moving averages is to help you determine the trend. The simplest way is to just plot 50-period SMA moving average on the chart. When price action tends to stay above the moving average, it signals that price is in a general uptrend. If price action tends to stay below the moving average, then it indicates that it is in a downtrend. What some traders do, and what we suggest you do as well, is that they plot a couple of moving averages on their charts instead of just one. This gives them a clearer signal of whether the pair is trending up or down depending on the order of the moving averages. Let us explain. In an uptrend, the faster moving average should be above the slower moving average, and for a downtrend, vice versa. For example, let's say we have two EMAs, the 9-period EMA and the 22-period EMA. On your chart, it would look like this. We will now show you a simple trading system used by many new traders. Moving average crossover is a simple and effective trading system. A moving average crossover occurs when a faster moving average lines cross over a slower moving average. We will plot a fast moving average. In this case, we will use a 9-period moving average on the US Nasdaq chart. We will plot a slower moving average, in this case 21-period moving average. Now let's study the behavior of the two moving averages. We are looking for a point in the price action where the price moves fast and the faster 9-period moving average crosses over the slower 20-period moving average. This is the point of the moving average crossover. We can now enter our trade at the crossover. We will hold our trade till the price action slows down and the 9-period moving average crosses below the 20-period moving average. This is a simple and effective trading strategy. If trading was this simple, every trader will be a millionaire. A moving average crossover system helps to answer these three questions. 1. Which direction might the price be trending at, an uptrend or downtrend? 2. Where might be a potential entry point for a trend trade? 3. When might a trend be ending or reversing? One thing to take note of with a crossover system is that while they work beautifully in a volatile and trending environment, they don't work so well when price is ranging. You will many crossovers and most of them will be losing trades, which will really hurt your bank balance. This is the main reason why traders need to use a pro trading system. We will share the smart trading system with you in the bonus section. We will now share some very important information about moving averages which you must fully understand as a trader. Moving averages not predict future price direction, instead, they define the current direction with a lag. Moving averages are a lagging indicator, and if the price action moves suddenly, you will be caught out as the moving average will not have time to plot the sudden movement. Moving average crossover trading does no work when the market is ranging. Just as almost any other Forex indicator out there, moving averages operate with a delay. There is no indicator that can predict future price movements with accuracy. We promised you a bonus, and we want to share with you the Smart Cloud indicator from smartforextrading.com. This indicator has been developed by pro traders and takes all the guesswork out of trading. Smartforextrading.com have developed an amazing indicator which uses a complex set of moving averages with fast and slow smoothing to give a highly accurate trading signals. If you liked the moving average crossover system we just mentioned, you will simply be blown away by the power and accuracy of the Smart Cloud. Let us just show an example. The Smart Cloud will show you accurate trends, and it will also show you when the market is ranging. The biggest problem in trading is knowing when the market is ranging. Using the Smart Clio, we can quickly see areas where price action is ranging. When there is no cloud or the cloud line is flat, do not trade. Instead, you can go to the gym. The market is ranging and this is the time traders must wait. Here, when we can see a crossover and the cloud is forming, we can safely enter the trade and we just stay in the trade till the cloud changes color. We can jump out of the trade with a very healthy profit. So instead of experimenting and trying to figure how and when to use a crossover strategy which may not work and can lead to huge losses, you can simply use the Smart Cloud and start trading profitably straight away. The Smart system is used by over 90,000 traders and you should try it yourself. Remember, when you have a system, trading becomes really easy. Let me just repeat that, as it is just so important. When you have a trading system, trading becomes really easy. And you can start banking thousands of dollars every day. We look forward to meeting you in the next lesson, and quickly, if you have not yet subscribed, help us out. Just hit the subscribe button now. We really appreciate your support. If you have any questions, please leave them in the comments section. We do read all your comments. And just a final reminder, if you have not yet checked out our website, head over there now and you will find one of the most profitable trading systems used by over 90,000 traders. Check it out now on smartforextrading.com. Thank you, and I look forward to seeing you in the next lesson. Help the channel to grow. Like, subscribe and turn on bell notifications. We hope you enjoyed the lesson and we will see you on the next one.